Now it's time for Smart Charts with Abigail Doolittle, where we look at some of the timely topics through the charts. And this week, Abigail, well, you're looking at charts related to the Fed decision.
That's right, Caroline, because with me is Paul Ciana, the Bank of America Merrill Lynch technical strategist for FIC, and also an award-winning one, AAII, institutional investor.
Yes.
I'm getting my little short acronyms messed up. But in any case,
okay.
You are an award-winning technical analyst, so we're very happy to have you here again on Fed Day. So let's check in on the 10-year yield chart that you've presented before and see if the messaging is the same.
Sure. So today was a big day for 10-year Treasury yields in the bond market, given the FOMC decision to cut interest rates. And here we look at a chart of U.S. 10-year Treasury yield going back since we made the bullish call in fourth quarter of 2018, suggesting 10-year yields would fall. And indeed they have. The question is, do they continue to fall? And is this bull market in the bond market over, or do they continue? In our technical view, we don't have enough evidence just yet to say that 10-year yields are breaking out. In fact, they've risen from a slightly higher low in October to test this trend line that goes all the way back to 2018. So I think the technical rule of thumb is to essentially keep buying bonds while below this trend line. If we begin to pierce this, that's about 1.86%. Okay, we may be able to adjust our view a little bit more, but I think bond market is continuing to rally, and we may come back down another 20, 30 basis points here.
And so you are definitely talking more about reactive technical analysis, where you are reacting and respecting the trend in place. If you were going to do predictive, and I don't know how much you look at patterns, is that a possible double bottom or area that could send a big backup in rates back above 2% or so?
You know, what I think could form here from the predictive angle is potentially a triangle. If you connect this high here of about 1.9% to 1.86, you have a slightly lower trend line. And then, of course, you would have the same coming up this way. So that means we would do 1, 2, 3, maybe this is 4 to a third higher low. That could potentially lead higher, maybe up to 215 or so. But
so anywhere
to be seen.
Yes, and that would also, I imagine, create a little bit of a buying spurt for you before that potentially happened.
That's right.
So let's now take a look at your dollar-yen chart, because we have some agreement here. One of the long-term charts that I always think about, it's possibly scary about a potential period of risk-off in the future, is the yen-dollar, so the inverse of this. So talk to us about what you see with the dollar-yen.
So here we look at the ratio of the dollar versus the yen. And this is an important chart because dollar-yen tends to rise as 10-year yield rises. So as we sort of look forward into that potential predictive triangle pattern that may form in 10-year yields, well, dollar-yen should break out through the neckline of its head and shoulders bottom pattern that's formed over the course of the last 5 months. Now, today was a very interesting day, Abigail, because dollar-yen rallied to a high of 109, I believe 28. That's just 4 cents away from a 5-month new high. The market came in and said, nope. We're selling dollar-yen, right? We're buying bonds, and we're not breaking out yet. So the rule of thumb with technicals is you don't call this a base and call for a rally to 114 unless there's truly a breakout. Same goes with 10-year yields.
So you would be shorting the dollar-yen and buying bonds, and here's another chart to really bring all of this together.
Yeah, so when we look long-term at the positioning trend of dollar-yen up top and the 10-year Treasury yield down bottom, we look all the way back to 2004, and this is like an oscillator almost, right? And as we come forward to now, what you see is this pink line rose all the way to this level here. That meant the market was very long yen, or essentially short dollar yen, and they've taken that off as dollar yen has rallied. So dollar yen goes up, this positioning comes down. That's perfectly normal. But what has not happened is no budge in the positioning for the bond market. So bond market investors are still not buying into phase 1 of the U.S.-China trade deal. They're still not buying into the Brexit negotiations. They're still fearful of these macro risks. So if dollar-yen breaks that level, 109.32, I would expect some of this positioning to come off, which would lead 10-year yield higher through that trend line of 1.86%. Until then, stick with the trend.
And I have to tell you, you've had some great calls, especially on that 10-year yield, sticking with that downtrend.